good afternoon, good morning, good afternoon, or good evening. And wherever you're watching us, welcome back again to our Zoom. Inshallah, today or tonight, we have Ustad Suleiman Ibrahim with us, and he will be continue where he left the lesson last Friday. And guys, help me, or let's welcome with him 999, type 999. Let's welcome Ustad Suleiman Ibrahim.
Okay, thank you, Kev. Hello, guys and girls. Let us continue with our session from where we left last time. I'll be sharing my screen right now. If you can hear me, please type 22 in the chat box. If you can, okay. So I guess everyone can see my screen. So we will go back to support and resistance again. I'll start from there today. Yeah? So support and resistance is one of the most used techniques in technical analysis, based on the concept that's easy to understand but difficult to master. It identifies price levels where historically the price reacted either by reversing or at least by slowing down, and prior price behavior at these levels can lead for future price behavior. By actually looking at support and resistance, you can actually have a you can actually see where the market price might actually go to next. So there are many different ways to identify these levels and to apply them in trading. Support and resistance levels can be identifiable turning points, areas of congestion, or psychological levels. Round numbers, actually the numbers are like 1.128 point something or 1.2 full without any decimals. Those numbers traders attach significance to. The higher them, more relevant the level becomes. So let's continue. So here is a picture of a chart. You can see here is a support, and support you know is as a flow. And then here we have the ceiling or the resistance. Now this price here, it moved from this place, went up, hit the ceiling, the resistance came down, and then respected the support of the floor, and then it moved up again, went and touched here, and then it was resisted, came down. So you can see when the price came to the support, and then it showed like a couple of candles, buy candles, and then if you understand the candles, then you know it's going for an upward move. So you can follow it from there. And then when it comes here, it came, retested the support again, broke through the support, and then came down. So now support returned turned to be another ceiling, a resistance. Whenever you see a resistance, the price usually moves for a sell. So the price came down, red candle to see, came down, and then the green candles was a pullback, and then the price then touched the resistance again, the ceiling, because this one is whenever it touches the ceiling, the resistance, the price tends to fall. It goes for a sell. It went down for a sell. It dropped. By just understanding support and resistance properly, you can actually know by analyzing into the candles where the price will move next to. So in technical analysis, support and resistance is a concept that the movement of the price of a security will tend to stop and revise at a certain predetermined price levels. These levels are denoted by multiple chances of price without a breakthrough to the level. So the price touched multiple times the support around here, which here in our case will become the ceiling or resistance, and then by respecting this, it went for a sell. So if you've understood until there, give me one in the chat box. Support and resistance, the idea of support and resistance. If you're together, 1. Okay, let's go. And then here we have a picture of another chart. So here we have the support, which is the floor, the resistance. So price came to the support once and then went up, touched the ceiling, and then broke through the ceiling, and then the price fell down. Touched this resistance again because it tried to go up, so it couldn't break through this. So this one will turn to be a resistance, and then the price came down, made a second touch on the support, and then went up, a second touch on the resistance. Okay, what does this tell us? This tells us there's a actually a support and resistance trading strategy. Trading strategy by using support and resistance. Okay. First of all, what you do is you mark your areas of support and resistance, or SR, and then wait for a direction. So here you have your support, and then here you have your resistance. You've already marked by placing the horizontal lines, support and resistance. So you wait for a directional move into the support or resistance. So here, there was a move. When price came from here, this point, and then from here, it made a pullback, hit the resistance. When it came like on a downward movement, and then the price made a pullback, hit the ceiling, the resistance, and then it fell. So here, it came down to the support. So there was a directional move from up to down, okay? And then here, there was another directional move from down to up. And then you wait for price rejection at support or resistance. When price went up by this pullback, it was rejected. It came down, and then it was rejected again at the support, and then it went up, broke through all the way up, and then came down, and then it was rejected at this point, and then it came for a sell. Okay. What else? And then you enter on the next candle. By entering the next candle, you actually when you know when you have support, there's usually a buying pressure. So you have to look for like a couple of candles, green in color, blue in color, which identifies that these are buy candles. And then by entering the second candle, you're like sure of your entry, and then you move with the trend, because the trend is always, or you move with that direction because the trend is always trend. Or when it hit the ceiling, you know when it hits the ceiling and is rejected on this high, the price usually comes falling down, and that's a sell. So you don't enter on the first candle because you don't know that maybe like a candle of indecision, anything might happen. So you wait for a confirmation on the next candle. That's when you enter, and then you follow the trend or where the price is moving to. And then by here, you're told you use risk management. By using risk management, this is one of the ways that you use proper lot sizes for your account, and you get to protect your account. You don't blow out your account in one trade. That's what the use of proper risk management is. And then here you're told to create a take profit and a stop loss. So now we understood this concept, I guess so. But let's move to the chart, the actual chart. So here we have a currency pair. If you can see, the currency pair is GBP CAD, Great British Pound to the Canadian dollar. So if you're together up to there, give me 3 in the chat box. 3. Okay. So here we are going to like see how our strategy was going to work. Okay. On the 1 hour chart. So when you are going to place our horizontal, our support and resistance, we use the horizontal lines. Come here, horizontal line, you pick one, and then we press one here. This is where the price came. So this is our support. And then here we will place another line to have our resistance, because price, when it came to the support, it went up for a buy, and then it was rejected at this point. This one is our resistance. And then we move with another one. Here, let me just place it here. This is another place of rejection where price actually broke the resistance. It went up, hit this resistance, and then it came down. This one turned to be the floor, which is the resistance, which is the support. So let's place another one. We put where there was like a price rejection. The price went up, rejected. Price went for a sell, and then it was rejected. That's how you place your support and resistance, the horizontal lines. So the next thing that we do is you're told to wait for price rejection at structure, at support or resistance. So these are our support down here, and then these are our resistance. So if we move here, when price went up, it came to the resistance, and at this point, price was rejected, it came for a sell. So you can't enter the first candle, you will have to wait, you will enter with the second candle. That is what I mean by, and then you follow it for a sell. Okay. And then the price went up again, went up, and then hit this resistance. And then the price came down for a sell. It's actually how it went down, like a couple of pips. Yep, 69 pips. So the next thing is where you enter on the next candle, yes, which you've indicated. Like for this here, for this resistance here, we were using like the next candle is this, the first candle, the second candle, and then wait for another red candle, like this candle. Now, this is where we enter for a sell. Okay. And then we use the proper risk management. That's by identifying your lot size, and then you create take profit and stop loss. So suppose you enter the market here for a buyer. You enter the market here at this substructure level for a buy. You didn't enter with this candle, you enter with this candle. So how are you going to place your take profit and your stop loss? So what you're going to do is you come here. Since you're going for a buy, you'll go for long position and then place it here. And then try to move with it. When you place your stop loss at the last rejection, this was the last rejection where it happened. So you follow this one. This is where the price might be rejected again. So if it goes beyond this, take me out of the market. You can actually slightly bring it down, and then you have your stop loss. So this is the stop loss. You have the amount of pips, which is 7 pips. And then this red number here is what you're going to use as a stop loss, knowing that your stop loss is 7 pips. And then your entry was here. You followed this blue candle. So you wanted to follow it for a buy. But how do you know where your take profit is? If you want to follow it for the long ride, so you will look at this resistance, the first resistance, and then you will look at the second resistance, which was here. So you will say, let me follow it up to here. These are a couple of pips, which is 91 pips. And then there's something called risk to reward ratio. So your stop loss is 37 pips, because you see here it's 37.7. And then here 91.5 is your TP, it's the take profit. This is the reward, this is the risk. So you have a reward of 2.4%. So it's like you're going for more than 2% of your meaning. So if you like, this is how you create take profit and stop loss. The take profit will be this green number here. So suppose you want to know like how much are you going to gain, how much are you going to lose. You just double click and then it opens. So this is the amount in your account. You can actually use like if you want $100, if there's $100 in your account, and then how much are you risking? Let's say we don't go for more than 1 to 3%. So let's use our 2%. Yeah, 2%. So this was the entry price. This ticks is the profit level. These are 91 is the 91 pips you're seeing here, and then this is the price of that. The take profit where it is, and then you come here for the stop loss. So let's say that you don't want to lose more than 30 pips. But for our rejection point here, where we indicated it was 37 pips, 377, you ignore the last digit, just go for the first 2 digits. So 37 pips. Okay, let's see, okay. So you have it here. So since you have $100 in your account, you have 7, and then there's a number of pips, and then the amount, which is $98. So you're losing like 2% of your account, which is $2. So here, this is the amount that you know. If this trade goes against me, instead of going for a buy, it goes for a sell, I will lose $2. And if this trade gains, it will goes up, my account will be, I will gain like 4.85. So your account will be, the amount in your account will be increased to 104.8. So if you understood how to create take profit, stop loss, and we'll go into depth along the way. And if you know how to set up your support and resistance, please give me 5 in the chat box. Okay, together. Thank you. So we've seen the support and resistance trading strategy. So support, we know, is the area on your chart with potential buying pressure. Resistance are areas on your chart with potential selling pressure. So this one is just a chart showing you how the area of support is. Support here, price came down, it was rejected here, it went up. The next candle is where you enter, and then you follow it. Potential buying pressure. And then this chart indicates an area of resistance. An area of resistance is where potential selling pressures are. You follow it for a sell on the next candle, not the first candle, but the second candle. So we've seen also uptrend, the highs, the lows, the higher highs, the higher lows in our previous classes, the downtrends. Uptrends are also known as swing high, swing low. Downtrends are known as swing low, swing high, ranging market. We've seen all of this. And then the trend line, we've seen them. Trend line, a line on a graph showing a statistical trend. This one is a downtrend coming from up to down. This one is a uptrend coming from low to high, upward trend. Okay, here is another one indicating instead of using the highs and the lows, you can actually use the swing high for the high and the low, swing low for the low, which means the market came from high, this swing high, it came to this swing low, which was an end of a run and before a pullback begins in a downtrend. This market was a downtrend, and then this green candle, which indicates a buy candle, went up, showing that this is a pullback. The market needs to breathe through pullbacks. So another swing high was created, the market came down, swing low, another pullback by these buy candles, and then the swing high, end of a pullback, the pullback ended here. This red candle indicates we are beginning for a downtrend sell. So end of a pullback and before a run begins in a downtrend. So the market came swing high to down, pullback, swing high, swing low, swing high, swing low. Those are just highs and lows. So in the next picture, we have a market coming in a downward direction, a downward trend. So the market, by going downward, it came and touched the trend line. It broke through the trend line, retested on the trend line by this. Retested actually means by touching again the trend line by this red candle, and then it went up for a buy. This is where the break of the trend line happened by these two candles. And then this is where another trend changed from a downtrend to an uptrend, because you can see from this green candle to this other green candle, this is not a downtrend, this is an uptrend, it's a buy, it's a market for a buy. So this one is another picture showing trend change from a downtrend. The market was coming in a down sell, and then from here the market broke through the trend line and another trend line was made, which is an uptrend. So trend change from an uptrend to a downward trend again. Since we are an uptrend here, so the market the market came down for a sell. So the candles broke down the trend line. This is where the break happened, the candle of the trend line, and then it came for a downtrend. So this is another trend line showing for a downtrend. Here is another, it's just a trend line but put in like two trend lines, which is like more of a channel. So this one is a downward trend or a downward channel, and then the green candle broke the trend line, and then it went up, but it didn't change, so it continued as a downtrend again. So break and retest of the trend line and continuation of the trend line. And then here we have price reversal zones. Price reversal zones are areas around support and resistance where price tends to reverse. Support and resistance, all of these horizontal lines. So price broke here, retested here, and then it reversed, came to the support, and then when it reversed, it went for an upward. Here was another resistance. It came down created another reversal, and then it went up, reversal down, and then reversal up. So price reversal area zones are areas around support and resistance where price tends to reverse. So let's look at our charts. By looking at our chart, for instance, this support resistance, let's look at around here. Let's look at here, this area. So price was coming down. It went, okay, let's just continue. So price came on this structure. Instead of going down for a sell, it reversed, it went up, and then touched here, and then it came down, and then reversed for an uptrend. So the price came ultimately to this high, this resistance, the high resistance, and then from this area, by indicating the sell candles, the price reversed. This is actually support and resistance actually act as areas where price usually reverses. So if you understood up to there, give me 66 in the chat box. If you're together up to there, 66. Okay. Thank you. So the next thing is we're going on a confirmation checklist, which is equals to high probability trades. The first thing is the support and resistance. The second thing is the price reversal zones. The third thing is the trend line. And then there's a pullback. Okay, so let's check if we have these for a confirmation checklist. Let's look at a drawing first of all. So in this drawing, we have a support, this zone, support resistance, and then we have the trend line coming from up, down, downtrend, and then we have price reversals. When the price was coming down, there was a pullback, price hit here, and then there's a reversal, price came down. These zones, and then indicating, and then there was a pullback. So these are the high confirmation checklist with the support resistance, price reversal zone, trend line, pullback. So these are the things that you look for. You draw a trend line from down to up if you're trying to see the uptrend of market, and then analyze the price. So you follow it by the touches on the trend line, and then you mark your areas of support and resistance. You have a trend line? Yes, there's a trend line. You have an area of support and resistance? Yes. Is there a reversal of price? Yes. So price reversals are usually used to, or the pullbacks are usually used for entries. When it comes and it touches this, when actually the price went for a buy and then it came for a sell, touched the trend line, and then it indicated a couple of candles. By this pullback or this by touching again the trend line, this pullback, it actually gave the people, the traders, an entry to follow the market for an uptrend for a buy. That's how you use it. And this is another chart of a market that is going for from an uptrend to a downtrend. It's a downtrend movement by just seeing the trend line and the support and resistance. And then price broke. There was a price reversal, touched the structure or the resistance, and then the price dropped. Here's another picture of there's a trend line and an uptrend market. And then there was a zone here. Then the trend line was touched, pullback, and then it went up. And then another pullback, giving you another entry to follow the market for a buy. So that's mostly about support, resistance, and the trend lines. So the next, if you're together up to there, please give me an 88 so that no one's left behind. 88. So together. So the next thing we'll go to is the risk to reward ratio. Risk to reward ratio, what we were seeing, the stop loss and the take profit that we actually showing earlier in our chart. So risk is the amount that you're expecting to lose, and then reward is the amount that you're expecting to gain. So risk to reward ratio should be, the risk should be less or equal to the reward. So here 1:1 is when you have a stop loss of maybe 30 pips, you're risking 3%, and you're looking for a take profit of 30 pips, which is also gaining 3%. So that your risk is equal to your reward. You're gaining 30 pips to lose 30 pips. So here we have risk, which is a stop loss, and then to get, which is a take profit, and then risk to reward ratio. And then here is this one is the TP, the reward actually, and then this is the ratio. So we have bad, good, and better. So with bad, you're actually trying to lose 35 pips, and then you're trying to gain 15 pips. You see your risk is higher than your gain, your take profit, because this is more than twice the amount you're trying to gain. So here you're for a loss, which your risk reward ratio is 0.42, 1:1, which is a very bad risk to reward ratio. The next, here you have 35 pips as your stop loss, your risk, the amount that you're willing to lose, and then to get, which is take profit, is another 35 pips. So your loss and your reward is equal. Here, giving you the risk reward ratio 1:1. This one is actually a good risk to reward ratio. Most of the traders used to go for like this one here, the better one. The risk is usually smaller than the reward. So when you are trying to lose or risks that are at 35 pips, here you are gaining 7. So your risk to reward ratio is 1:2. That's twice the amount of your loss. So if this trade goes in your direction, you've actually got a good return, which is better. So here still is the risk, is the explanation of risk to reward ratio. Your risk should be lower than the reward. This one here, the risk is heavier than the reward on the scale. So this means it's a bad risk to reward ratio. This one here is a good one because there's a balance between your risk to reward. You're not losing more than you're trying to gain. And then the better one here, your risk is smaller when compared to your reward. You can actually see this one, your gain is double the amount that you're trying to risk. So that is the risk to reward ratio. And then here there's a factor in the spreads with your risk to reward ratios. So the spreads are actually calculated by the ask price and the bid price. When you subtract the ask price and the bid price, you get a number, which that number becomes the pips. By just subtracting this number to this number, you get 2 pips, 2.1 pips spread. This one is a small spread, which is okay. Your high spreads can affect your percentage risk. So when you're going for a trade that has like a lot of spread, a big spread, a wide spread, then you know that if you are a trader who usually grows the account, your account compoundingly like 2% or 3% or 5% a day, then you know that when you go for more than that, you will have you will spoil your trading plan, because your risk will be very high if you go for like an 8% risk. So here, if trade goes against you, you lose what you agreed to risk plus the spread. The spread is also the amount that your broker usually charges you when you enter trade. So if you're together up to there, the risk and the reward ratios, give me 9 in the chat. Thank you. So the next thing is there's a position size calculator. This one, you can actually use it by like trying to understand how much are you going to lose. We have these spaces where you will like include the amount and stuff. The first one is okay, let's go direct to it, position size calculator. See how it my Facebook. So here it is, position size calculator values. The account currency, this one here tells you like which type of an account are you using. Are you using your account in US dollars, NZDs, New Zealand dollar, Japanese yen, Great British pound, euro, whichever your currency that you're using is, just put it there as USD or whichever currency it is. So your account size, how much is the money in your account? Let's say for maybe there's $1,000 in my account. So how much is my risk? To how much are you going to risk in that trade? 2%, whichever you use, but don't go above 3%. And then the stop loss pips. How many pips is your stop loss? 30 pips. Let me say that 30 pips. The account currency pair here. Here is the currency pair that you're actually going to trade for, maybe GBP, AUD. And then this is the entry, the ask price that is going with the price there. And then you just say calculate. And then it gives you $20 is the amount that you're going to risk to lose, your account will be minus $20 if the trade goes against you. And then the units is the number of lots in your account of the currency pair, sorry. And then the lots is the volume that you're going to indicate in your trading account. So this one will like basically tell you if you're worried like how am I going to calculate my risk to reward ratio, you can just come here, indicate everything in the boxes, and then you just say calculate. That is how like you get to know before you enter that trade, this is the amount that I'm going to risk, and this is the lot size that I will be using in my trades. So if you are together up to there, and we understood the position size calculator and how to use it, give me 5 in the chat box. Okay, seems like we're together. So I guess there are no questions because I don't see any questions. So this was my time, and thank you for all attending this session. So guys and girls, thank you. We will meet tomorrow again.